It takes me upwards of 20 hours to create one individualized financial plan for a specific client. But it took AI only 10 minutes to create this one right here. So we need to answer two questions. One, how did I do this? And two, is it any good? Now, spoiler alert, it was really easy to do and the results are actually pretty insane. Okay, so I already have this prompt generated. So this is the blank one. You could fill this out with your information if you want. Now, I would be really, really careful putting your personally identifiable information into an AI system, but this is just for testing purposes anyways to see, if this is any good. So I made up a fake client, Mark. He's 25 and lives in California. So this is all of his information. I'm going to go ahead and just copy and paste this. Now, if you want to follow along, you can do the same thing that I'm doing here. But we're going to go ahead and just copy this and then move over to Claude and paste this in and send it off. So we're using Claude Sonnet 4.6, but ChatGPT, Gemini, they should all be able to do something very similar. I'm not really sure about using the other two. Obviously, Gemini is going to have a Google Drive plugin, but I know that Claude has a Google Drive plugin as well. So once this plan is completed, we're going to actually open it up in Google Drive. But this is probably going to take about 5 or 10 minutes for it to create. So I'm going to run, grab a coffee, and then I'll be right back. All right, got the coffee. Looks like the plan is done. So let's get right into this. All right, so I went into the financial plan already and put a couple of highlights in purple. That way we know, what we actually want to talk about. Because it's 25 pages. It's going to take way too long to get through all of this. So I just wanted to touch on a couple of key things. First of all, I like the urgent priorities here. This is a really good section, something that people should, start to work on almost immediately. The financial snapshot, liabilities, net worth, this is all things that we don't need AI to calculate for us. We can do it pretty easily. And it's just information that we gave them. Now, the budget optimization, nothing to note here. Budgeting is not too difficult. I think, again, budgeting is not something that AI should probably be doing for us, especially with tools like Monarch Money and stuff like that. Now, one thing that I did note, so they did make the recommendation to open up a tax reserve account, in a high yield savings account, which is great. But they do say immediately transfer 28 to 30% into this account when you're getting these payments, because this is a freelancer. While that's fine when you're just making these estimates, 20 to 30% could be well over or well under what the actual tax obligation is going to be for this person. So working with an actual financial planner or a CPA can get you much closer to an accurate number. Now, it is recommending, these different high yield savings accounts, but it's saying that they're doing about 4.5 or 5% yield right now. And that's just way out of date. Unless they're doing some type of promotion that's going to last 2 or 3 months. But you're not going to get 4.5 or 5% in a high yield savings account right now. Now, the variable expense reduction tips, this is just kind of crazy to me because it's just assuming so much about who this person is as a person, telling them to meal plan weekly, audit all of their subscriptions, use zero-based budgeting apps. I mean, it's just making a ton of assumptions about this person without really understanding who they are or how they act. Now, moving on to the emergency fund. So how much do you actually need? This is actually a really good section that I like, but it still does miss a couple of key things here. So it is making the recommendation to have, 6 months minimum, starting off with 3 months. However, it talks about this income volatility buffer. However, what I do with my clients, especially freelancers, is set up a completely separate account. We call it the buffer fund, and that's going to help them for when they have slow months, they can take from the buffer fund and pay themselves from there to fill that gap. And then in the high months, they could pay back that buffer fund. But this is just not talking anything really about that. It's just in regards to the emergency fund. Now, this is fine. It's telling us that we have $8,500 right now. We should just place that directly into the emergency fund. And then that leaves us with about a $2,100 gap. Contributing $500 a month will take 43 months. But then when we have big projects, we can drop lump sums into it to accelerate that process. So that's fine. That's decent recommendations there. Moving on, again, these yields are just way out of touch. I mean, this is not what you're getting in the market right now. Now, the tax optimization section is by far the worst part about this entire financial plan. Now, I'm not going to get into the nitty gritty and go through every little detail about this plan, but like I said, it is pretty awful. Top tax reduction strategy. Strategy 1, solo 401k, SEP IRA. First of all, they're saying that they can contribute 25% of net earnings. This is a sole proprietor, so it's actually 20%. So that's just wrong, let alone the amounts, which we'll get into in just a second, because I don't know how that person is going to make those types of contributions. So here we go. Contribute at least $23,500 per year. Where is this person going to get $23,000 every year? And then we move on. Okay, strategy number 2 is contribute to the Roth IRA, another $7,000. Where is this person getting $30,500 from if they barely have $1,000 left over and they still need to fund their emergency fund, They still need to save for taxes, all of this different stuff. I don't understand where or how this AI system thinks that this person is just going to have all of this excess cash to complete all of these different goals. Then it gets worse. We go into these business deductions and it just starts making random assumptions of what our deductions or what our expenses look like. So how are we spending between $2,000 and $5,000 on computers and equipment? How does it know that, right? It's just making these random assumptions. Again, $500 to $2,000 on software and subscriptions. Additionally, I told it to be very specific about the numbers. Obviously, it couldn't here. It should have asked more questions. But if it couldn't ask questions, then it shouldn't have just filled any of this information out because it's completely useless if these estimates are huge ranges. So all of this is just absolutely completely useless. Let alone it says, top strategy number 1, solo 401k. Theoretically, it could be. If you're maxing out to the very tippity top of the solo 401k, it could be the top tax reduction strategy. However, this client can't make those types of contributions, so there's going to be other strategies that are better for this person, such as the QBI and the S-Corp strategy. So qualified business income deduction, and then also electing S-Corp at $100,000, he could be saving a lot on the self-employment taxes, but it said absolutely nothing about any of this. All right, sorry about that. I got a little worked up. I had a sip of coffee. I'm cooled off now, but now that I'm scrolling down, this part is going to piss me off again because it's making the assumption that we have an effective tax rate of 34%, or at least the way that I understand what it's telling us to do. It's saying, we need to save $8,570 per quarter, which is $34,280, which at a $100,000 salary puts us in the 34, assumes that we're in the have an effective tax rate of 34%. Absolutely insane. If somebody who's making $100,000 has an effective tax rate of 34%, fire that CPA immediately because that's just unheard of. Strategy 5, health savings account. Great. If we have the money, that's an awesome option to do. Now, moving on to the retirement planning, not much to say here. I mean, it's pretty good. It has this 3% per year inflation adjustment. It talks about the 4% withdrawal rate, which is, pretty much the industry standard here. So this is all fine and dandy. However, again, annual contributions, where is this money coming from, right? All right, let's do $7,000 per month or per year. This person could probably afford that, but then $23,500? Probably not. And then they add them together. We get to a total of $40,000 per year that this person's supposed to be contributing. I don't think so. They're going to have $20,000 at the end of the day to live on. And that's just not going to cut it. All right, account priority, max out the solo 401k, max out the Roth IRA. Just crazy stuff here. I would argue that the Roth IRA might be more beneficial for this person's situation if they're self-employed making $100,000 and they have the potential to grow this business to, help them make maybe $200,000 or $300,000 down the line. Then the Roth IRA is probably going to be the most significant thing that they can do right now. So again, I don't know where these priorities are coming from. It's not taking any of that stuff into account. I'm not going to get into the Social Security considerations. The debt payoff is pretty standard. However, down here, it does say that the psychological freedom of zero debt is worth the small mathematical trade-off. So basically what it's saying is that we have 4.5% in student loans, and we could assume that we could get 7% from the market. And there's that 2.5% difference there that we could be getting if we invest instead of paying off the debt. But the AI system is basically saying that we should just pay off the debt because it's not worth the burden of having any debt. But what I put here is assuming that the freedom of zero debt is worth the trade-off. What if this has zero effect on the actual person? What if they don't care that they're carrying the debt and they know and they trust in the financial plan that they have that investing in the market is the optimal strategy? Now, moving into the home purchase planning part, we did say that we wanted to buy a house in 5 years. However, none of these are taking into account any first-time home buyers programs. So that would obviously help here. I mean, it is laying it out, I guess, for us. Now, down payment saving strategy. Again, where are we getting this money? Like, this is where, as a financial planner, you have to sit down with your client and have a serious conversation with them about how unrealistic their goals are. Now, it does recommend putting this money into a high yield savings account and then doing laddered T-bills. Just completely unnecessary. It's just making this so much more complex than it has to be. I like that it does talk about the Roth IRA first-time homebuyer exception here. So if you didn't know, you can withdraw up to $10,000 of earnings penalty-free for first-time homebuyers. And I do like that it says that this is a last resort, not a plan. So that's great there. However, you do have to start the clock on your Roth IRA because there is a 5-year clock, meaning that you have to contribute and then give it 5 years to build up before you can actually qualify for this. So you do have to start that clock, and it doesn't mention anything about this. So that's a pretty big issue there. Now, it does start to mention here some of the first-time homebuyers programs, which is good, but it's just like, check the availability of it. Now, the investment strategy. This one's honestly not that terrible, but a couple of critiques here. 35-year runway, it's only assuming that our only goal is to invest in the stock market for retirement. That's an issue in and of itself, but then to put 5% in bonds, 5% in REITs without understanding. Actually, I did tell it that this person was as aggressive as it possibly gets. So putting 5% in bonds with a 35-year runway is pretty crazy to me. And then we put in 5% in REITs as a buffer. What are we buffering against? We have a 35-year runway. Do we really need a buffer at our current age? In addition, there's a big gap between what they can contribute and what their goal is. So being as aggressive as possible and taking advantage of that could be beneficial for this person. Now, the actual funds themselves, that's fine. Super low cost ETFs, which is great. I do like that they do this account specific holding strategy. So this is pretty accurate. In the Roth IRA, since it's tax free, you do want your highest growth assets in there. In the solo 401k and the SEP IRA, REITs, bonds, high dividend stocks, that's perfectly fine. And then in the taxable brokerage account, it says just, overall stock market, just trying to avoid any payouts. So dividends and bonds, those types of things. So this is actually a very good section. Now, the specific fund recommendations, I'm not going to make specific fund recommendations to anybody, but if you want to see what my actual portfolios look like that I use with my clients, then take a look at last week's video because we actually go through all of that. Honestly, this is pretty similar. I think we use every single one of these funds minus the REIT. Now, behavioral guardrails, this is actually pretty nice that they put this in here because it's a new and up and coming kind of segment of financial planning is the behavioral side of it. So setting up automatic contributions is going to remove the decision entirely. That's great. Rebalancing annually. This is an issue. This is a big issue here because it does not talk about what rebalancing is, when it's useful, when it's not. This is what I put. If we're rebalancing in the brokerage account willy-nilly, like once a year, we're going to be causing ourselves capital gains tax probably every single year without even realizing it. So there's other strategies to rebalance things like a brokerage account without actually causing that tax gain. So you could take the contributions and distribute them between the funds proportionately so that we get the portfolio allocation back to where it's supposed to be. Whereas in something like a solo 401k or a Roth IRA, you can pretty much rebalance whenever you want because there are no tax implications of it. Now, should you? Probably not. What some people do is put like a 10% buffer. If the allocation goes outside of that 10% guardrail, then it rebalances, or they also set up, annual rebalancing. Now, the insurance gaps, this is completely fine. I have nothing to say here. I like that they're prioritizing disability insurance, talking about planning for health insurance because this person's about to fall off their parents' plan, and then also some professional liability insurance as well. So this is pretty good, all of this. In terms of the estate planning, the beneficiary priority, this is the biggest thing. A lot of people do not use this, and it creates a lot of issues. So I do appreciate that they put this in here. And then I like that they also, kind of created a plan for it. So do this week, within 30 days, within 60 days. And all of these are things that pretty much everybody who's probably making the amount of money that they make should have. Now, the last thing is this phased action plan. This is actually something that I told it to create, but it does look pretty good. I like how they do like the first 30 days, the next 4 months, phase 3, the last 6 months of the year. And then phase 4 is, going way out into the future. So that's pretty much what a financial plan looks like that I create with my clients. So before I answer whether or not I think that this financial plan is any good for any purpose at all, I want to show you guys really quickly just what a financial plan looks like that I create for my clients. So right off the bat, we have their key goals and their values. Now, the values is something that the Claude plan didn't talk about at all, but we like to fill this out for our clients. We actually go through like a 50-question survey to figure out what their values are so that we can align their money with their values and make sure that they're spending according to that. Below that, we have key metrics to really track how healthy their financial picture is. So emergency fund, debt rate, burn rate, savings rate, these are some very important metrics to understand. And then on the right side, we like to just track their net worth to see if it's growing over time. And then key metric recommendations. What can we do to make your financial picture healthier? On the next page, you'll see the tax sheet with a tax allocation in the top right corner. Again, something that Claude did not talk about at all is tax diversification. This is super important if you plan to retire early or if you just want to decrease your tax bill in retirement. Now, below that, we have the tax paid in 2024, tax estimate in 2025, or whatever the current year is. And then we have these super detailed federal and state tax cards calculating what their actual tax should be and how much they need to save every single quarter. Moving forward, we have the investment sheet, which has their current allocation, their recommended allocation, how their portfolio has performed in regard to the benchmark, what their risk tolerance is, all of that. Next, we have our insurance and trust section, which has an insurance calculator. Now, this is for life insurance, but it helps calculate what your coverage actually should look like. And then, like we had mentioned before, the beneficiaries is a super important part. So we also do that with our clients. Now, in terms of the surplus plan, this is where we get into the meat and potatoes of everything. So we first want to calculate what their surplus is and kind of show them where their money is going. So we have this cash flow summary that shows grow, how much money are you saving? O, how much money are you paying on debt? Live, how much money does it just cost you to live your daily life? And then tax, how much money is going to Uncle Sam? And then we calculate their surplus for them. And once we have that, then we go into this super detailed action items. Now, you can see the cash flow planning section on the left. This usually, when we fill it out completely, is going to end up being 2 to 3 pages because we get, again, super detailed with this, telling them how much exactly to save every single month for quarterly taxes, how much they should be saving every single month with their emergency fund. And then once we cap it out, then once we achieve a goal, we reallocate those funds to the next goal. So you can see how it goes progressively. It gets bigger and bigger and bigger. Other than that, we just have these other little sections, which are basically summarizing the cash flow planning. So the debt management is going to be included in the cash flow plan, but then we'll talk about it just a little bit there. The very last thing that I wanted to touch on is this mortgage sheet. So if the client does have a mortgage, then we'll go over the mortgage with them and basically to show them how much money they're paying in interest and what it would look like if they made additional payments towards the principal and how that would affect the mortgage. I misspoke. Last thing is actually the implementation plan. So you saw the implementation plan that Claude put. That's because I do something very similar and I wanted Claude to put something as well. Theirs honestly looked almost exactly like what we would do with our clients. So A+ for Claude in that situation. Now, at the end of the day, is an AI financial plan any good? Honestly, it could be. For the right person in the right situation, it could be. But the second that complexity enters your life, it gets very scary listening to some type of AI because we already pointed out to you how it was missing out on the S-Corp election. It was missing out on the QBI. And then it was just making these crazy assumptions that we have all this extra cash that we can actually be contributing. So if you can get it to not hallucinate like that, and you also understand that it doesn't do well when dealing with complex situations or just the human brain in general, then it could possibly help you create maybe like a good debt repayment plan, maybe a budget if you really need it to. But at the end of the day, like I said, when complexity enters, I think that's the time to talk to a CPA or a CFP. Now, that's all I had for you today. I hope you really enjoyed it. And if you did, please leave a like, comment, and subscribe. I really appreciate you guys. And until next time, cheers.